Hey fellow entrepreneur, it's PK Patel from Midwest Corporate Credit, where funding your business is our business. Today we're going to cover everything you need to know about receivables. What are receivables? Why you need funding for receivables. I'll tell you a couple stories about our clients that you're going to learn from, and I'll give you 3 tips on how you could successfully get funding for your receivables. What are receivables, or accounts receivables, or AR as they're sometimes referred to? Well, it's nothing more than the gap between when your business renders a service to a customer and when you get paid. For example, let's say you go to the dentist. You do go to the dentist, right? You go to the dentist on the first of the month. And he works on your teeth. Maybe has a dental hygienist work on your teeth. Either way, 30 days go by. And you might get a bill, you might not, or it might get sent to your insurance company. Either way, the dentist has not gotten paid. However, he had to pay all his fixed expenses as well as his staff. He had to pay the dental hygienist whatever, $40 or $50 an hour to work on your teeth. Your bill might be $250, but it is not paid immediately. You might have a small copay, but that may not even cover what the dentist shells out in order to work on your teeth. So sometimes it can go 60 days. These are your accounts receivable, the money that is owed to you for a service or product that has already been delivered. Why does a business owner need to finance his or her receivables? Well, let's use our dentist friend as an example. You're going to go to him on the first of the month. He's not going to get paid until the 30th of the month. Let's say our dentist friend, his cost to service you is $50. That means the free toothbrush, the mini toothpaste, paying his dental hygienist, the little bag that it comes in, the whole kit is going to cost him $50, right? We're just going to use round numbers here. Now, you're not the only patient he has. Let's say he has 1,000 patients that he could service in a 1-month period. So that means he's going to need $50,000 in order to meet his overhead every single month. 2 things he could do. Number 1, he could pay it out of pocket, but if he does, his bank account could go as dry as this marker did there. So that's an option. He could do it if he's got enough cash. Or he could go out and get receivables financing. Even if he has to pay a little bit of interest on that money, it allows him to see more patients and scale a little bit faster. And it keeps him from not using his own money or going insolvent. So those are the reasons why a business owner would want to use receivables financing. All right, guys, now I'm going to tell you a story about 2 actual clients that we took on. One was named Jim, and the other one, you guessed it, Joe. How did you know? You are so smart. Anyways, we had Jim and Joe, and they both came through our program to get financing for their receivables. So let's talk about Jim first. The type of business that Jim had was very unique. He's in the oil and gas industry, and what he did was he provides service to some of these big oil and gas companies to work on their equipment. So he was basically a subcontractor of large companies. So we're going to call it service. Location? Take a wild guess. That's right, he was in Texas. Terms that he offered to his clients. So basically, how long did he give his clients to pay their invoices after he rendered his service? 0 to 90 days, depending on who the client was, how long they've been in business, how stable they are financially. Usually some of the larger companies he gave better terms to, okay? Revenues. $4 million a year is what Jim's company was earning in gross sales. All right. Net profit, 25% or $1 million. Jimbo was doing A-okay. Credit, Jim had excellent credit, and he'd been in business for about 20 years. Number of clients, Jim had 4 clients. By now you probably guess who they are. BP, ExxonMobil, Amoco, and Chevron, or one of those 4 major ones. Now, let's go to Joe. Joe had a similar type of business. Joe's business renders services to car dealerships. You know when you go to the car dealership and you hear those, they service your car and you hear that gun and it makes that noise like well, what that is an air compressor in the back room that is compressing air, and that's what they use. And Joe's company rendered service and sales of these air compressors to automotive dealerships. So he's a very similar type of business. Service. Location, he was right here in the Chicagoland area. Terms, same thing, 0 to 90 days, depending on who the client was and the amount of volume they brought in, their financial stability, and so on and so forth. Revenues, you guessed it, $4 million. Net profit, exactly the same amount. About 25% or $1 million a year, okay? Credit, Joe had excellent credit. Years in business, Joe had only been in business for 8 years. Number of clients, this is where they're separated. Right here it is. Joe has 116 clients. All these different dealerships around the Chicagoland area that he rendered services to. Now, we were able to get both of them funded with receivables lines of credit for the same amount, $500,000 credit facility, right? The only difference is Jim got terms that were a lot worse than Joe. %16 interest. Versus 7.5% interest for Joe. Now you're probably wondering, why is that? Well, the key difference here, even though Jim had been in business a lot longer than Joe, look at the amount of clients. He had 4 major clients. So what would happen if Jim lost one of the clients? Let's say the executives at BP had a meeting and they said, you know what? We're gonna cut that division and we don't need that service anymore, or we're gonna close that oil well and we don't need Jim's company anymore because there's nothing to service. Well, here's what would happen. $25% of Jim's business is gone. What are his profit margins? 25%. Or $1 million. So now what it looks like is his gross revenue is $3 million and his net profit, 0. A big fat goose egg. And guess what? The lender doesn't want to take that kind of risk. So what they'll do is they'd rather lend to somebody that's more diversified, has a broader client base, because what would happen if, let's say, Mitsubishi of Chicago went out of business and Joe lost that client? Well, he'd have 115 clients, but his revenue would be impacted by less than 1%, assuming that all 116 clients brought in the same amount of revenue, right? So because Joe was more spread out, the lenders were more comfortable taking a risk on him because there's a lower likelihood that Joe is going to suffer a big loss and therefore default on that line of credit that they're giving him. Now, at the beginning of the video, I promised you 3 tips in order to help your receivables financing expedition be successful. Well, I'm glad you haven't forgotten, because neither have I. So tip number 1, you probably already know, is be well diversified. Don't have too many eggs in one basket. Basically, you have a broader client base, the banker is going to be more willing to take a risk on you and give you better terms. Number 2 is make sure you keep your credit excellent. If they're going to trust you with $500,000 in credit that you could do whatever you want with, in this case you're going to fund your receivables, they're going to expect you to have shown the ability to manage debt properly, right? So business and personal credit should be excellent if you're going to go for a credit facility like this. Number 3 is your timing. This is a very, very clever trick. They're going to give you a certain percentage of your receivables, and depending on how liberal or conservative the bank's underwriting criteria is, they're going to give you anywhere between 70 and 80% of your total receivables. So let's say you have $1 million in receivables, for example. You're going to end up getting between $700,000 and $800,000. So how do you maximize that? Here's what you do. Let's say you're a seasonal business, or you have a business which is busier during certain times of the years but not others. For example, landscaping company. We actually had a client that was a landscaper, and we helped him get a receivables line because he did a lot of commercial projects, apartment complexes, hospitals, office buildings, and same thing. He would render his service, so he'd have to pay his guys, and then he would bill the clients on a 30, 60, or 90-day basis, depending on how large the client was. So what do we do for him? We make sure that he applies when his receivables are high, which means sometime around July, when it's the peak of season, that's when we would be able to go in and get the maximum amount. Now, think about it. If he's a landscaper in Chicago, does he have any receivables in January? No, he doesn't. So it's pointless to go out and get receivables funding at that time, because you have to be able to show that you have these receivables that you want funding for. And usually you're going to get the least amount of resistance if you go during busy times when you actually do have those receivables, because if they're past 90 days, banks don't like to count those as actual receivables. So keep that in mind. Excellent credit, timing, and be well diversified. If you keep these lessons in mind, you should have no problem getting funding for your receivables. However, if you need professional help and you want me to do all of this for you, I can do it. Just go to applymidwest.com. On the upper right-hand corner, there's a green button called Apply Now. Click on that green button, fill out a form, and send it over to us. We'll do a free consultation for you. And if you like what you hear, we'll move forward and we'll set up this kind of a credit facility for your business. If you enjoyed this video, subscribe to our YouTube channel. For Midwest Corporate Credit, I'm PK Patel.